What I'd like to focus on today is really sort of AI related stock movements. There's been lots going on over the course of the year, and in fact you may have seen the Magnificent Seven, these sort of tech bellwethers that have done so well out of the AI trade in recent years, are actually down year to date. And so the question is, should we be parking the bus like Ghana did against England in the middle of the week? Or are there creative ways to sort of look forward from here and remain constructive on the prospect for these businesses and indeed related tech businesses, and perhaps even more meaningfully, the broader markets out there too? So let's start with a little bit of context. The Magnificent Seven have done exceptionally well, as I'm sure you know, over the last few years. As of today, their market capitalization is around about 20 trillion US dollars. They account for about a third of the US main index. So they are really substantial and important businesses, sitting firmly sort of atop that market capitalization index, both in the US and indeed globally. Now, generally speaking, of course, these big names at the top of indices tend to be a bit sort of stodgy, a bit perhaps unexciting, and you expect their prices not to move around too much. You think historically, of course, these sort of massive conglomerates with lots of different business lines, lots of different brands and bits and pieces, no one particular business unit would likely have such a big impact on the overall prospects of the business. And so, their stock market performance generally would be considered to be perhaps a little bit unexciting, a bit more stodgy compared to smaller companies, which generally speaking would have a sort of greater focus on one or two product lines, much greater sensitivity to that revenue stream and profitability. And so generally speaking, the smaller companies tend to be more volatile and the larger ones less so. Nevertheless, this massive cohort of stocks in the US have actually been pretty volatile year to date. So let me give you some context of the progression over the course of 2026. The Magnificent Seven started the year under pressure, actually fell double digits to the end of March, then had a decent rally up around about 28% from their lows this year to the end of May, and since then have come off about 13% or so to end their year-to-date position to the end of yesterday, as it happens, down around about 6.5%. Elsewhere in the US, the broader index is actually up over that period, and tech-related stocks generally are up pretty substantially over that period. So it's not simply a case of all tech selling off. It's really a much more sort of focused trade over the course of this year. And what's interesting around that is the AI trade is arguably becoming much more focused, much more nuanced, rather than sort of having a one-size-fits-all approach. Suddenly, you're seeing some elements doing relatively well and others coming increasingly under pressure. To give you, some round numbers around that, if that cohort is 20 trillion US dollars in round numbers, moving around about 10%, of course, those kind of moves in a month or so is plus or minus $2 trillion in terms of overall valuation, which is pretty massive. To give you some context around that, the German stock market is around about $2-3 trillion, depending on when you look at it. So you're looking at adding most of or taking away most of the German stock market out of the US over the course of the month. So these are massive businesses, and that volatility is pretty unusual. The volatility more generally in markets is measured. There is some sort of elements that suggest nervousness. The VIX index, the so-called Wall Street fear gauge, is sitting around about the 20 level, which is higher than sort of long-term averages, but certainly below real sort of peak anxiety sort of levels. So it's just showing a sort of gradual increase in nervousness rather than anything more profound than that. The interesting thing about the AI trade today is it seems to be broadening and actually perhaps being a bit more selective in terms of what's doing very well and what's doing less well. So while the Magnificent Seven is not really having it all its own way this year, having of course done very well for many years, there are parts of AI-related technology stocks that are doing very well indeed. Storage, you've probably read about storage and the impact of storage prices indeed on Apple and Microsoft over even this week. But storage is up around about 200% so far year to date. Data centers and related sort of infrastructure type names, some of those are up around about 100%. And even some semiconductor AI related tech sitting up, 80% plus over the course of the year. So it's not a case of all AI coming under pressure, but certainly a more sort of judicious allocation of capital over recent weeks and months. And that perhaps speaks to a maturing of the theme. It's sort of quite logical in many ways that after that first burst of optimism, investors start to sort of look around a bit more sort of selectively, and perhaps it makes a strong argument for why in these sorts of markets it makes sense to consider active management if you can, because you want people to be making judgment based on valuation, based on fundamentals, and allocating capital in a selective, in a judicious way, rather than simply buying the theme in a sort of a naive, market capitalization weighted approach, because market capitalization doesn't necessarily, reflect long-term prospects. Arguably, it reflects the scale of businesses and what good news is perhaps already in the price. So for investments more generally, coming back to our question at the start, is now the time to be parking the bus, or could we think of a more sort of constructive investment strategy? Where things stand today, as much as AI is sort of capturing the headlines, what's quietly going on behind the scenes is a sort of reduction of tension in the Middle East. You may have seen oil price coming back down to the levels it was before the original strikes in Iran, right at the tail end of February. And so one of the big concerns that was sort of simmering away behind the scenes over the course of 2026, this inflationary risk that was posed from higher energy prices, and indeed a restriction of traffic generally through the Strait of Hormuz. The immediate impact of that is diminishing, and in fact, that inflationary spike that we saw coming through data in the last few months should start to diminish purely through the mathematics of oil price going up and now coming down. That will ease pressure on consumers. That should help economic activity generally, and just reduces the risk of that sort of very severe stagflation environment that was being mooted even only a few weeks ago. And perhaps a reminder of the point we made at the time. They were sort of catastrophizing around oil going to $200 a barrel, and we made the point, it's more likely you'll see some sort of muddle through. And actually, the resilience of investors over that period has been pretty impressive. Bond markets have increased yields, generally speaking, over that period, starting to see some easing back there. But overall, the resilience was pretty impressive. And perhaps that's the way to finish the video this week. There are, outside of a very sort of focused AI theme, which remains, of course, a really important long-term story for productivity, a long-term story for how we go about working and indeed, running our lives. But there's plenty of opportunities outside of that for investors who've got long-term, disciplined, diversified approach to investing. That's it from me. Have a good weekend when you get there, and we'll see you next time.